This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It's Wednesday, March 11th, 2015. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals. In the intermediate term, risk, and in the short term, confidence and sentiment. This month, I'd like to cover a range of topics listed here. This will be the first year since 2008 without easing. Big moves always look for support at some point, and I don't think 2015 will be any different. I believe we'll have scares, and I believe a recession scare is highly likely in 2015, which will force the Fed's hand to avoid one. I think that first, as I've been saying for some time, we're going to see real deflation, and I believe it's already underway, broadly based, but hasn't yet shown itself in the only general standing, and that is the S&P 500. Then that will come home to roost. Will be followed by inflation and possibly hyperinflation. Recently, we have begun to see weakness in the U.S. equity markets. It has been so long since we've had anything other than relentless increases. It is time to consider what we might expect for even a mild consolidation, or heaven forbid, a possible correction. I'm regularly reminded how similar the current situation is to 1987 and 2000. The markets disconnected from all measures then, as today, but just kept on going up. In the fall of 1999, I recall, during the dot-com bubble, I exited the market because I felt the risks were just simply too excessive. Having did that, the markets, however, just kept going up. I looked very silly, and I might say a lot of people gleefully pointed this out to me, as I recall. However, eventually, in March 2000, the markets cracked and the dot-com bubble was burst, and soon the sell-off was brutally underway. When I reminded those who had chastised me the previous fall about having exited, the feedback was usually the same. Quote, "No one could have seen this coming," end of quote. My experience in 1987, 2000, and 2008 is that after the fact everyone says this. No one could have seen this coming. Just as similar is when warning them, as I am now, few paid any attention as they just didn't want to leave any money on the table and felt they were smart enough to get out early. When things break, liquidity disappears in a heartbeat. Things change rapidly, and the exits are clogged with similar thinking people, just as smart. Let's consider some of the worrying signs. I have shown many of these signs before, so there's no need to repeat myself, but rather let's see if things are as obvious as I make out. The first chart shows global commodity prices versus ZIRP and quantitative easing. The moment we started to talk seriously about the possibility of taper, commodity prices began diverging from the growth of the Fed's balance sheet. Stock prices kept going up and tracking very closely, but commodity prices didn't. When taper was complete and liquidity injections were actually stopped, commodity prices then plummeted, while stock prices continued to go up. Why would this be? Think of it this way. Quantitative easing, by making money cheaper, brought demand forward. Supply reacted accordingly, and with cheap money readily available, overbuilt the supply. Both now are at artificial levels and require further demand to be brought forward to sustain these new higher levels. Money historically can't get any cheaper than zero, so it is difficult to bring further demand forward to fill this hole. As soon as demand slows, suppliers immediately cut material orders. Commodities and freight and shipping rates fell. The Baltic Dry is presently at levels not seen since the 80s. Sales have been falling and earnings have recently been brought down significantly. Markets, however, just keep going up as they see a hockey stick in year earnings results occurring for some reason. They may be right, but I'm highly skeptical of that. You can believe anything if you really want to. The balance sheet growth has clearly stalled, slowing liquidity. As Warren Buffett is known to say, you see who is swimming without a suit when the water starts going out. Well, the water isn't going out yet, but in 2015 we will experience the first year since 2008 that money supply wasn't increasing, and this will be a test for the markets, minimally. We should expect to see the equity markets look for short and intermediate support, something they haven't done in quite a while. The truth is that the U.S. economy has been and is on life support. Money has not been flowing to the real economy for capital investment. Money has been used for all sorts of financial engineering schemes. Last quarter, for example, 90% of all profits from the S&P was paid out to investors as dividends and stock buybacks. That leaves a maximum of a possible 10% for investment in growth. Without it, only a matter of time before it's not going to occur. This has been going on for some time, and the top-line growth estimates reflect this. They've been falling and not even keeping up with inflation, which along with a strengthening U.S. dollar is putting crushing pressures on margins. This is why you still hear of American Express cutting 2,000 people despite profits, and HP cutting yet another 58,000, though they are one of the few remaining computer corporations still standing and took out, 46 to 47,000 last year. There is little doubt that Fed liquidity has been the driver of the U.S. equity markets, and the correlation has been as precise as any I can recall seeing. Throughout 2014, trading this correlation has been the best investment strategy anyone could have had. The Fed telegraphed well in advance everything it was going to do, and even the banks couldn't fail to make profits and continue to repair their balance sheets at the expense of savers and pensioners. The last rally actually took the correlation well above the red line, shown here, and stretched it to the total value of the Fed's balance sheet, shown in orange. Clearly, some just don't believe the Fed has any intentions of following through on its talks of rate increases. In fact, I am one of them. As soon as the market shows weakness, the Fed will capitulate. There will be some minor short-term rate gains, but you can be assured that the Fed balance sheet will be larger than it is now by this time next year. It is my opinion that the Fed will try and rally on every one of the many support points on this long rally leg. So far, the central bankers have shown it is open season on bears. Bears will continue to be shot on sight. The Fed has $300 billion in reverse repos stashed away to stop any sell-off getting out of control. Collateral contagion is their fear. The Fed will have its hands full, however, as the 13-week rate of change of flows goes into contraction. Watch this correlation closely to see how much runway the Fed really has before it must abandon any pretext of ending further liquidity injections. Like a drug, the habit cannot be kicked without tremendous effort. We are only talking about rehab here. We haven't even yet entered the full and difficult program. The Fed's 13 rate of balance sheet change has closed tighter on its correlation with the 10-year Treasury yield than normal since the financial crisis. Yields have been falling despite the Fed stopping its bond buying program. The shortage of available Treasury paper, because the Fed took so much of it out of the market, makes it difficult to get by those incented by capital ratios to hold it, and hence prices are being forced up and yields down. All of this is clearly a strategy to keep interest rate costs of the U.S. debt from rising. The recent weakness in the equity markets can be expected to test support of the traditional support levels of the 50, 100, and 200-day moving averages. If these moving averages begin to cross to the downside, the markets will look for deeper levels of support. The Fed can likely tolerate an 8 to 12% consolidation, but anything more stands the risk of margin calls and falling collateral values. If that happens, then we can expect prices to revert to longer-term regression levels. Those would include regressions of the latest rally leg, the lift since the 2008 bottom, and even those going back to the dot-com top and pre-dot-com bubble days. All regressions are rising strongly and would likely be primary support targets. This chart, going back just prior to the 1986 crash, shows what I am referring to about long-term rising means. It is highly likely that sometime over the next 2 years we will test or break the mean shown in green and drawn on this log scale. You will notice that wouldn't be much higher than the double tops of the dot-com and housing bubbles, and as traditionally was considered overhead resistance becomes support. A scare to the market could come out of anywhere. One that would not surprise me in the least in 2015 is the increasing possibilities of a U.S. recession. Historically, we should be looking for one about now. I've talked about this before, and we have had many signs of this being a real possibility later in 2015. A possibility. The Fed will react as soon as it even smells this coming. It is interesting how many trends are following means so closely. Any disruptions to these flows, for various reasons, could quickly plunge the U.S. into a recessionary mindset worry. On Friday, we learned that the official unemployment rate has fallen to 5.5%. Since an unemployment rate of 5% is considered to be full employment by many economists, many in the mainstream media took this as a sign that the U.S. economy has almost fully recovered since the last recession. In fact, according to the Wall Street Journal, some Federal Reserve officials believe the U.S. economy is already at full employment. So what in the world is going on? How can the government be telling us that we are nearly at full employment when so many people can't find work? Could it possibly be that the government numbers are misleading? Many contend that the official unemployment rate has become so politicized and so manipulated that it is essentially meaningless at this point. Since February 2008, the size of the U.S. population has grown by 16.8 million people, but the number of full-time jobs has actually decreased by 140,000. The percentage of working-age Americans that have a job right now is still about the same as it was during the depths of the last recession. The primary reason for the decline in the official unemployment rate is the fact that the government now considers millions and millions of long-term unemployed workers to be no longer in the labor force. Okay? The growing food stamps program is indicative of this and shows how we in fact may have never left the last recession, and it has been a game of false numbers and government spending. The G in the equation of the GDP calculation has become extreme when considered at all levels of government, and it makes a GDP barely positive. And in real terms, if we used a real deflator, we would find that it is actually contracting in my assessment. We talked during our last long wave about the energy shocker. I believe it is indicative of the real deflationary phase we are now in. That is not to say we don't have inflation. We certainly do. We have both concurrently, which I have described where many times before. They are just occurring in different financial areas and in different countries concurrently. Gold may have been down in U.S. dollar terms over the last 24 months, but in other currencies it has been a performer. A stronger U.S. dollar has hidden the global strength of this traditional inflation protection asset. 2015 may turn out to be the breakout year for gold against its long-term mean. Similar can be said for silver, which may even outperform gold. Time will tell. If we look at nominal market prices going back to 1900, we find that the current rally of 174% as of February close ranks as the sixth longest rally in history, and that without stopping for any sort of consolidation breather. There is only one reason for this, and 2015 will be the first year since 2008 that we haven't had the Fed pumping money all year, at least so far. Valuations are stretched to record levels, so we should expect markets to want to test some level of support sometime during 2015. It's simply to be expected. Though the real deflation leg is well underway, as I said, the U.S. equity market prices currently just defy it. They may be the last to fall, but they will fall. Then we get inflation and the real possibility of hyperinflation. Remembering, hyperinflation is a currency event which explodes prices higher as confidence in the currency is in fact lost. That's what's ahead of us, and that is likely to give us new highs before this final lift is over. I continue to fully expect a Minsky melt-up before all this ends very badly, possibly in late 2015 or early 2016. Eventually, it will be clear to all that the central bank policies have been a failure. The government's policy of financial repression is just becoming too heavy-handed, and that jobs are continuing to disappear at a phenomenal rate as 75 million baby boomers remove themselves from the labor market and start drawing down on their assets, which pulls money from the financial markets. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2015 be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.